Welcome, curious minds, to the deep dive. Today, we're plunging into a truly fascinating, maybe even a bit perplexing, puzzle in the financial markets. We're talking about the U.S. small cap market, specifically the Russell 2000 index.
Yeah, it's a really interesting one right now.
On one hand, if you just, look at the numbers, some of them, it appears historically cheap, like really cheap, bargain territory maybe,
Potentially, yeah.
on paper. But then you look closer, and it embodies some pretty acute vulnerabilities. It's this real paradox, a contradiction that just begs for a deeper look. So our mission today is to unpack this whole complex picture. We want to get into its current valuation, put it in historical context, especially next to the big guys, and explore what its behavior really tells us about the broader U.S. economy.
Right. What's the signal here?
You definitely hear about the S&P 500, the NASDAQ 100 all the time. They're the titans, right? Household name. But the Russell 2000, people often call that the real barometer of Main Street America.
That's the common wisdom, yeah.
Yeah.
A proxy for domestic activity.
So the big question is, why is this really crucial part of the market showing such a contradiction? Why is it trading at one of the widest discounts to large cap stocks we've seen in, well, modern history? What's really going on underneath? And importantly for you listening, what does it imply for your investment outlook? Let's try and figure it out.
It is a compelling puzzle, and understanding it, well, it means looking way beyond just the surface headlines. We're not just talking about companies being smaller. We're talking about an index with a fundamentally different economic exposure, different sensitivities. And because of that, it's a profoundly different investment proposition compared to, say, the S&P 500.
Right, apples and oranges. Almost.
Exactly. The current situation, it really demands a nuanced interpretation. And we hope we can provide some clarity for you today on what could be, either a generational opportunity or maybe a classic value trap.
Okay, so we've set the stage, this contradiction, this puzzle. Before we really dive into that valuation paradox, we need to nail down what the Russell 2000 actually is. It gets mistaken sometimes, doesn't it? Like just a mini S&P 500. But it's really got its own DNA.
Absolutely. That's a really common misconception. I mean, yes, both are market cap weighted indices, but how they're built and who's in them, that makes them profoundly different. The Russell 2000, specifically, it's a small cap index. It comes from the broader Russell 3000 index.
Which covers most of the U.S. market.
Yeah, about 98% of the investable U.S. equity market.
Yeah.
So from that big list, they take the top 1,000 largest companies and kick them out for this index. What you're left with are the bottom 2,000 stocks. Companies ranked like 1,001 down to 3,000 by size.
Okay.
And this isn't just a small size difference. It means even the biggest fish in the Russell 2000 pond is still way smaller than the average company in the S&P 500.
Right. That scale difference alone must change things.
It fundamentally changes the economic exposure, the risk profile, definitely.
Yeah.
And there's another critical detail, maybe a bit overlooked sometimes, but it matters for how the index behaves. It's the annual reconstitution.
Ah, yes, the big rebalancing act.
Exactly. Every June, like clockwork, they reevaluate the whole list.
Yeah.
Based on market caps from the end of May. It's purely rules-based, mechanical, but it can lead to pretty significant turnover.
Companies growing out, shrinking in.
Are getting bought, going bankrupt, all that. And this isn't just, shuffling paper. It's a huge event, billions of dollars moving. All those index funds tracking the Russell 2000, they have to buy and sell to match the new list.
Forced trading.
Right. And that forced trading, it often creates real short-term price dislocations.
Yeah.
Little bumps and dips that active managers try to exploit.
Interesting. So it adds its own layer of volatility each year.
Definitely. A unique liquidity event just for the small cap world.
That's a great point about reconstitution. It shows how dynamic the space is. But beyond size and mechanics, there's this other huge difference you mentioned, geographic revenue exposure. This really sets it apart from the S&P 500, doesn't it?
Massively. Yeah.
The S&P 500 is full of global giants. Multinationals getting, what, like 40% of their revenue from outside the U.S.?
Roughly, yeah. They're sensitive to currency moves, global trade, what's happening in Europe or Asia.
Global corporate America, as you put it.
Exactly. And if the S&P 500 is global corporate America, then the Russell 2000 is, well, it's pure Main Street America. It's a stark contrast. Companies in the Russell 2000, on average, get over 80% of their revenue from right here in the United States.
Wow, 80%. That's huge.
It is. And that overwhelming domestic focus is what makes it such a pure barometer of the U.S. economy. Its performance is just intrinsically tied to American consumer spending, U.S. business investment cycles, the health of regional economies.
Literally what's happening on the ground for folks and local businesses.
Precisely. So what this means for you as an investor or just an observer is profound. When you analyze the Russell 2000, You're getting a much clearer, less diluted signal about the U.S. domestic economy.
So if U.S. consumers pull back,
Or small businesses face tight credit.
or manufacturing slows down,
The Russell 2000 feels that pinch much more directly, much faster than the big, globally diversified S&P 500 companies.
it's not just scale, it's a different economic engine.
Fundamentally different. So if you, say, believe the U.S. consumer is resilient, or maybe there's a reindustrialization trend happening.
The Russell 2000 is where you'd see that reflected most directly.
Exactly. It's the purest play on that domestic story.
And I imagine this domestic focus translates directly into a very different sector makeup as well, giving the Russell 2000 a unique market flavor. It can't just be a watered-down S&P 500 sector breakdown.
You've nailed another crucial differentiator. It's structurally different. While sector weights obviously shift with the market, there are consistent key differences between the Russell 2000 and the S&P 500. And these differences, they really alter its risk, its return profile, make it sensitive to different economic currents.
Like what, specifically?
Okay, well, for one, it consistently has a higher weighting in financials.
But not the big Wall Street banks.
No, exactly. Think regional and community banks, hundreds of them. Their fortunes are tied really closely to the U.S. yield curve.
The difference between short-term and long-term rates.
Right, and local lending conditions. So when that yield curve inverts, like it has been, where short rates are higher than long rates,
That squeezes their profits, right, their
right,
margins.
puts significant sustained pressure on their net interest margins. It directly hits these smaller domestic banks in the Russell 2000. It's a much more direct play on U.S. interest rate policy effects.
Okay, financials. What else?
You also typically find a notably higher weighting in industrials.
Again, smaller scale.
Yeah, smaller manufacturers, logistics firms, business service providers, companies highly sensitive to the domestic business cycle. Think about indicators like the ISM manufacturing PMI. If that index, measuring manufacturing health, starts to slide,
These guys feel it first.
first and hardest, often. They usually have tighter margins, less diverse revenue. They're really the gears and cogs of the immediate U.S. production engine. Then there's significant healthcare exposure. But here's a really critical distinction for you.
It's not big pharma.
Not primarily. The Russell 2000's healthcare isn't about stable drug giants or insurers like in the S&P 500. Instead, it's much more a high-stakes bet on innovation. Think smaller biotech firms, often pre-revenue. Medical device companies still in development.
Ah, so more speculative.
Highly speculative, often valued on future potential, not current profits. Which means their performance hinges less on drug sales today and more on the availability of cheap capital for R&D.
So when credit tightens.
Or investor risk appetite dries up, this part of the index can get hit really hard. It's almost a bellwether for venture capital appetite, early-stage funding conditions.
Got it. And tech. It must be lower.
Significantly lower weighting in information technology. The Russell 2000 just doesn't have the mega-cap tech titans. No Apple's, Microsoft's, NVIDIA's dominating things. Its tech exposure is more like smaller hardware firms, niche software developers, semiconductor companies that are, again, often more cyclical and tied to domestic business spending, not necessarily those big global themes like AI.
Okay, so bringing it all together, financials, industrials, speculative healthcare, less big tech.
Right. For you, the implication is clear. This unique mix makes the Russell 2000 structurally more sensitive to specific economic variables. It's leveraged to the U.S. manufacturing cycle, to monetary policy shifts, especially that yield curve impacting banks, and to credit conditions hitting those early-stage biotechs.
So it's not just smaller companies, it's a direct bet on the cyclical health of the U.S. domestic economy.
Almost a pure bet, which makes it fascinating, but yeah, often more volatile. It really gives you that direct pulse on Main Street's financial health.
That breakdown is absolutely vital. Understanding that unique composition really sets the stage. Okay, so now let's talk valuation. The price-to-earnings ratio, the PE, is probably the most common metric people look at. But even this basic tool gets tricky with the Russell 2000, doesn't it? Especially distinguishing between trailing and forward earnings. Can you explain that difference and why it really matters here?
Yeah, that's an excellent place to start. Because for an index, this dynamic, this sensitive, getting the PE distinction right is paramount. The PE ratio, basically price divided by earnings per share. Simple enough. Trailing PE uses the reported earnings from the past 12 months. TCM trailing 12 months.
Based on actual results, audited numbers.
Right, that's the big plus. It's factual, verifiable. The drawback, it's backward-looking. It tells you what did happen, not what's coming. And for a cyclical index like the Russell 2000, whose fortunes can shift fast, looking backward might not reflect the current reality or what's anticipated.
Okay, so trailing is factual but potentially stale. What about forward?
Forward PE uses the consensus analyst estimates for earnings over the next 12 months. so it's inherently forward-looking. It's often preferred for valuing cyclical or growth companies because it tries to capture expected changes, an economic rebound, a slowdown.
But it's based on forecasts, educated guesses.
Exactly. That's the weakness. Forecasts can be wrong. Often are, especially when things are uncertain. But for the Russell 2000, because it is so sensitive to economic shifts, the forward PE is generally seen as more strategically relevant. It incorporates those market expectations of recovery or downturn, which is really where the investment risk or opportunity lies.
Okay, forward PE is generally preferred here, but now, here's where it gets really interesting, and honestly, pretty confusing sometimes. This negative earnings problem with the Russell 2000, it feels like it's Achilles' heel for valuation. What exactly is it, and why does it mess up the PE so much?
Ah, yes, the negative earnings problem. It's probably the single biggest challenge in using the Russell 2000's headline PE ratio. It causes massive distortions. The core issue is simple. A big chunk of the companies in the index, and it varies, but often 30% to 40% are unprofitable. They lose money.
30 to 40%, that's a lot.
It is. And these aren't necessarily bad companies. Could be early-stage biotech burning cash on R&D, high-growth tech focused on market share, not profit yet, or just cyclical firms in a temporary slump.
Okay, so lots of money losers. How does that distort the PE?
It's a severe mathematical consequence. When all those companies post losses, their negative earnings dramatically shrink the aggregate earnings for the entire index. The total E and the PE ratio gets tiny.
So the denominator gets crushed.
Exactly. And when the denominator is tiny, the PE ratio itself skyrockets. You see absurd levels like 100x or more, makes the index look insanely overvalued. Or worse, if the aggregate earnings for the whole index turn negative like in the 2020 recession, flash with, the PE becomes mathematically meaningless. You'll see it listed as NM, not meaningful.
Right, you can't divide by a negative number or zero in this context.
Precisely. So this extreme volatility, sometimes being totally incalculable, makes the headline trailing PE a notoriously unreliable guide. Frankly, it often tells you more about the proportion of companies struggling than about the actual valuation. It's highly misleading for a quick look.
Okay, that makes perfect sense why the headline number can be so wonky. So if that's unreliable, how do the pros, the institutional analysts, get a clearer view? What metrics do they use for serious analysis?
That's the key question. They know the headline PE is flawed, so they use several alternative, more robust methods to get a stable picture. One of the most common is the forward PE, excluding negative earners. EC.
Okay, say that again.
Forward PE, excluding negative earners. They basically calculate the PE using only the profitable companies in the index.
So they just ignore the ones losing money for this calculation.
Essentially, yes. It strips out that distorting effect from the speculative or deeply cyclical loss makers. It gives you a more stable, representative valuation for the core, cash-generating part of the small-cap world.
Like looking at the healthy part of the index.
Exactly. What's the real valuation of profitable Main Street America? That's what this tries to show. Another important one, especially given the Russell 2000's makeup, is the price-to-book PB ratio. Price divided by the net asset value of the companies.
Book value is more stable than earnings.
Generally, yes. Less volatile. So PB gives a steadier read. It's particularly useful for valuing companies with lots of tangible assets, like those regional banks and industrial firms we talked about. Their value is often tied more to their asset base.
Okay. And price to sales.
Price to sales. PS. Price divided by total revenue. This is super valuable for companies that aren't profitable yet, but have strong revenue growth.
Like those tech and biotech firms.
Exactly. Where future growth potential is the main story, not current profit. PS helps value that growth trajectory.
So analysts use these alternatives, forward PE, XNE, PB, PS. Do they use them together?
Absolutely. The real power comes from using them in concert. And here's something really insightful for you listening. The difference between the headline PE and that PE x negative earners. That gap itself is a powerful indicator.
How so?
Well, if the gap is really wide, it means those unprofitable firms are a huge drag on the index's aggregate earnings. That usually happens when the economy is stressed, credit is tight. So a wide, widening gap, often bearish, signals trouble at the riskiest end.
Okay.
But if that gap starts to narrow, if the headline PE starts moving closer to the PE x NE,
That means fewer companies are losing money, or the profitable ones are doing much better.
both, potentially. It suggests previously unprofitable firms are turning profitable, or the overall quality of earnings is improving. It's a strong bottom-up signal, broadening market health.
A leading indicator for a rally, maybe?
Often acts that way. It suggests fundamentals are genuinely turning a corner, not just sentiment.
That's a fantastic clarification. Really helps make sense of those potentially crazy PE numbers.
Okay, so let's apply this better lens. putting the current numbers in context. We hear about a high headline trailing PE, maybe 28x or something, but that's distorted, right? What's the real valuation story now?
Exactly. As of, say, late 2023, early 2024, the picture is complex if you just glance at the headline trailing PE. That 28x figure, maybe even higher sometimes, it is heavily distorted. Remember, maybe 35–40% of the index components are unprofitable. Stop there, you think, oh, expensive.
But using the better tools.
Using the better tools, a very different and frankly much more attractive story emerges. The forward PE, looking ahead 12 months, that paints a much more reasonable picture, around 15x maybe.
Okay, 15x forward, that sounds more normal.
It does. And then, if you go that extra step, calculate the forward PE using only the profitable companies, the X and E approach we discussed.
The cleaner number.
Yeah, the valuation looks even more compelling, perhaps in the range of 14.5x.
Wow, barely different from the overall forward PE, which tells you the profitable companies aren't wildly expensive. And it's this forward-looking valuation, especially the PE, X, and E, that institutional analysts really focus on. And crucially, this figure, around 14.5 by 15x, it currently sits at a deep discount. Not just to its own history. Small caps often used to trade at a premium, remember, but a very significant discount to large cap indices like the S&P 500.
So the headline number is scary, but the underlying forward-looking valuation looks cheap, relatively speaking.
That's the picture. It hints at potential hidden opportunity if you can look past the noise.
But this depressed valuation, this cheapness, it's not happening in a vacuum. It isn't arbitrary. It feels like there must be powerful macroeconomic headwinds hitting these smaller companies harder and driving this compression. What are those forces?
You've absolutely nailed the core drivers. This discount isn't just random market sentiment. It's a direct result of several major headwinds that hurt smaller companies more than the big guys.
Okay, what's number one?
First and foremost, interest rate sensitivity. Small caps are just fundamentally more vulnerable to rising rates.
Why is that? More debt?
Typically, yes. Higher debt loads relative to their cash flow. And critically, more of that debt is often floating rate, tied to benchmarks that follow the Fed's policy rate.
So when the Fed hikes?
Their interest expense goes up almost immediately. Squeezes earnings, compresses margins right away.
Unlike large caps.
Many large caps locked in low-rate, long-term debt over the past decade. They insulated themselves better from the immediate hit of rising rates. Their debt costs are more fixed.
Okay, rates are a big one. What else?
Second, beyond just the cost of debt, it's the availability. Credit conditions are absolutely crucial for small caps. They often don't have easy access to public bond markets like big corporations. They rely much more on traditional bank lending for working capital operations expansion.
So when the Fed tightens policy,
Banks tighten their own lending standards. We see it in the surveys, like the Fed's report Senior Loan Officer Opinion Survey. Banks become more cautious.
it's choking off the lifeline for small businesses.
It can, yeah. It hinders their ability to operate, invest, grow. A credit crunch for small business hits the Russell 2000 directly.
Makes sense. Rates, credit. What's the third big one?
Their inherent economic cycle sensitivity. We established it's a pure bet on the U.S. domestic economy, right?
Right. Main Street America.
So the Fed's aggressive tightening was designed to slow the economy down to fight inflation. That naturally raised fears of a recession, or at least a significant slowdown.
And that hits cyclical companies hardest.
Directly impacts investor expectations for their future earnings. When recession fears rise, investors demand a higher risk premium to hold these stocks. They pay less for uncertain future earnings.
Pushing the price down, making the PE look lower.
Exactly. It's the market pricing in higher risk for that domestic exposure.
So these factors, rates, credit, cyclicality, explain the discount.
They do. And they reveal a deeper truth about the current valuation. It's not just about past earnings. It's the market putting a price on the probability of two very different futures.
Okay, lay those out.
Think of it like this. Buying the Russell 2000 now is sort of like buying a call option on a soft landing.
Meaning the Fed beats inflation without a bad recession.
Right. Inflation cools, the Fed starts cutting rates. For small caps, that means lower interest costs, better access to capital, maybe surprisingly resilient revenues. In that world, current earnings estimates prove too low, investor risk appetite comes roaring back, and the PE multiple expands significantly.
So earnings E go up and the multiple P goes up. A double whammy rally.
A powerful rally. That's the bull case, the generational opportunity.
Okay, what's the flip side? The bear case.
The bear case is it's a value trap and a hard landing.
Meaning inflation stays sticky, rates stay high, and we get a recession.
Exactly. Higher for longer rates eventually tip the economy over. For these highly levered, cyclical Russell 2000 companies, disaster. Earnings wouldn't just stall, they'd collapse. Way more than expected now. Defaults, Bankruptcies would rise.
So the current low PE wasn't a bargain at all.
It gets exposed as a classic value trap. It looked cheap, but then the fundamentals fell out from under it, making it even cheaper. The initial discount wasn't enough compensation for the risk.
So for you listening, buying the Russell 2000 now is really a bet on that soft landing outcome.
It's largely that. Less about deep value today, more a direct leverage bet on the U.S. economy, avoiding a hard landing. The discount is your compensation for taking that big economic risk. It's a really high-stakes setup right now.
That framing is incredibly clear. It really highlights the conditional nature of the Russell 2000's cheapness.
Okay, so what does this mean for the broader market picture? Because the most striking thing, as you said, is this chasm in valuation between small caps and large caps. Is it possible we're overstating how unusual this is, or is this gap truly historic?
No, I don't think we're overstating it. It really is a chasm, and its significance is hard to ignore right now. Just look at the forward PE ratios side by side. Russell 2000 maybe around 15x. S&P 500 hovering around 21x.
That's a huge difference. It puts the Russell 2000 at roughly a 30% discount to the S&P 500. That's not just a blip, it's historically wide. Rarely been this extreme. Remember, for long stretches, small caps often traded at a slight premium to large caps. People paid up for that higher growth potential.
Right, the idea they could grow faster.
Exactly. The current situation is a complete inversion of that historical norm. Relative valuation near multi-decade lows. It's really unusual, signaling a big shift in investor preference and risk tolerance.
And you suspect this isn't just a cyclical thing, just a temporary blip. It feels like it's rooted in deeper, maybe structural differences that have just been amplified lately. Could some of this persist?
That's a critical point, and I do think you're right. This chasm isn't just cyclical. It's definitely rooted in several deep structural differences that the current environment, high rates, economic uncertainty, tech dominance, has really thrown into sharp relief. And yes, it's highly probable some of these factors will stick around, shaping things for a while.
Like what? What are these structural drivers?
Okay, first, let's talk profitability and quality. The S&P 500 is inherently an index of quality. Big, stable companies, market leaders, wide moats, strong pricing power, consistently profitable.
Resilient businesses.
Very resilient. The Russell 2000, as we discussed, has that long tail of unprofitable or barely profitable firms. More innovative, perhaps, but often thinner margins, less established, lower aggregate quality profile. So when things get uncertain, investors flock to that perceived safety and predictability of high-quality earnings in the S&P 500. You get a sustained quality premium. That's structural, amplified by volatility.
Okay, quality gap. What's next?
Second big one, growth expectations and the AI factor. The S&P 500's valuation is hugely skewed by those mega-cap tech stocks, the Magnificent Seven or whatever we call them now.
The giants driving everything.
Right. They're seen as having this unique, almost unstoppable growth path thanks to AI and other tech shifts. That narrative pulls in enormous amounts of capital, pushing their multiples sky high and dragging the whole S&P 500 multiple up with them.
And the Russell 2000 just doesn't have that.
Mostly lacks that dominant theme. It's more traditional cyclical businesses. It doesn't get that same flood of capital chasing secular growth. That's a structural demand mismatch.
Makes sense. Quality, AI growth.
Yeah.
What else?
Third, balance sheet strength. The S&P 500 tightens. Fortress balance sheets. Tons of cash, easy access to capital markets, even when credit tightens. Russell 2000 companies, generally more highly levered. Thinner cash cushions, more reliant on bank loans, credit lines.
Making them much less resilient to shocks.
Far less resilient to economic shocks, rate hikes, tight credit. Their ability to weather storms or fund growth is much more dependent on capital availability and cost, inherently more fragile in a higher rate world.
Okay, and the last one.
Finally, back to international diversification. The S&P 500's global revenue base is a buffer. Weakness in one region can be offset by strength elsewhere, a natural hedge. The Russell 2000's domestic focus. That becomes a liability when the U.S. economy itself looks shaky or is facing headwinds. No geographic diversification shield. They bear the full brunt of U.S.-specific problems.
So quality, AI growth, balance sheets, diversification, these structural factors really explain the gap.
They explain a lot of it. And it means this valuation spread, this gap between the Russell 2000 and S&P 500 PEs, has become a really useful real-time market indicator for you.
How so? What does it tell us?
A wide, expanding spread, like we see now, that signals a narrow defensive market. A K-shaped market where a few big winners thrive while the broad-based small businesses struggles. Classic late-cycle risk-off behavior, capital hiding in perceived safety.
And if the gap narrows?
A sustained narrowing of that gap. That would signal a healthier, broader market, more confidence flowing down from large caps into small caps,
Yep.
higher risk appetite. So watching this spread isn't just about valuation. It's a critical gauge of the market's underlying health, breadth, and conviction. A narrowing gap would be a potent sign a healthier cycle is starting.
It really helps to see how we got here. Let's look at the history, put this divergence into context. We've got the historical year-end trailing PE ratios here. Russell 2000, S&P 500, NASDAQ 100, from 2014 through 2023, plus current figures. This data really tells a story, doesn't it?
It absolutely does. A story of shifting market regimes.
Yeah.
And just a reminder, as we look at these trailing PEs for the Russell 2000,
Mhm.
remember that negative earnings problem.
Right, the distortions.
Yeah, you see NM not meaningful for year-end 2020 when aggregate earnings tanked.
Yeah.
And those high numbers in 2017 and 2023, they also reflect periods where lots of companies were losing money, suppressing the total E.
So the trailing numbers are bumpy, but they show trends.
Exactly. They reinforce why forward metrics are often better for comparing,
Mhm.
but the trailing history is still revealing. Looking over this decade, you can pretty clearly see three distinct market phases.
Okay, phase one.
Let's call it the pre-COVID era, roughly 2014 to 2019. This is the time of low inflation, zero interest rate policy, ZIRP, from the Fed. And look at the R2K versus SPX-PE spread ratio in the data. It was consistently above 1.0x.
Meaning small caps traded at a premium to large caps.
Consistently. Reached 1.20x sometimes. That reflected a healthy risk appetite. Investors were willing to pay more for the expected higher growth of smaller companies. Capital flowed more freely across market caps. Less worry about profitability when money was cheap.
Okay, that was the old normal, perhaps. Then what?
Then the COVID shock and recovery, 2020, 2021. 2020, you see that NM for the Russell 2000 PE as earnings collapsed. Huge turmoil, but brief. Then 2021 saw that massive rebound fueled by stimulus checks, government support.
Which helped domestic small caps a lot.
Disproportionately. Their earnings bounced back hard. But here's where the divergence started subtly. Look at the S&P 500 PE. It expanded even more rapidly, driven by those mega-cap stay-at-home winners. And for the first time in this period, the Russell 2000 versus S&P 500 PE ratio dipped below 1.0x in 2021, down to 0.87x, an early warning sign, even as small caps rallied.
Interesting. The relative valuation started shifting even then.
Exactly. Which brings us to phase three. The rate hike era, 2022 to present. This is where the great divergence really kicked in. Fed starts hiking rates aggressively in 22 to fight inflation. Both indices saw PEs compress from the 2021 highs, sure. But the impact on the Russell 2000 was far more severe, especially if you look at those forward PEs we discussed.
Even if the trailing numbers here are a bit noisy.
Right. The S&P 500's valuation held up much better. Buoyed by quality, balance sheets, the tech growth story, the valuation gap widened dramatically. The market started heavily punishing leverage, cyclicality, and rewarding quality, stability. You see the Russell 2000 trailing PE high again in 2023, 27.9x versus the S&P 24.1x, a ratio over 1. But remember the distortion. The real story in forward PEs was that deep discount emerging.
And what about the NASDAQ 100 in all this? Its PE is consistently the highest.
Yeah, the NASDAQ 100's role is growth dominance. Look at its PE, rarely below 25x, often above 30x. That just screams growth stock leadership. Heavy tech, high-growth consumer names always commands a premium. It's the extreme end of that secular growth narrative that contrasts so sharply with the cyclical, value-ish nature of the Russell 2000. Really shows the market's bifurcated focus.
So looking at this whole decade, what's the big takeaway for you?
The big takeaway, I think, is that we might be witnessing a genuine market regime shift. That old norm, small caps trading at a premium, it seems broken or at least seriously challenged.
The drivers seem more structural now.
The drivers mega cap tech dominance, higher baseline interest rates than the ZIRP era, investor preference for quality, they feel more structural than just cyclical right now.
Indeed.
Which means a simple reversion to the mean,
Yeah.
where the Russell 2000 PE just snaps back to its old premium. That's not a given.
It might need the old conditions back, near zero rates.
It likely would. A return to that premium probably requires a return to near zero rates and super low inflation. In this new normal of potentially higher for longer rates, the fair value for small caps relative to large caps might just be structurally lower than it used to be.
That's a critical point for long-term thinking.
Huge implication for asset allocation. You really need to consider the macro impact on small caps much more closely now.
Okay, let's try and bring this all together. It's been a deep dive, that's for sure. We have this picture of the U.S. small cap market at a really critical point. Historically inexpensive compared to large caps, yes. But that cheapness clearly reflects some very real rents tied to the economy, rates, credit. So for you listening, how do we frame the investment case now? Is the Russell 2000 that generational opportunity? Or is it a classic value trap?
That really is the core dilemma. And honestly, the path forward hinges almost entirely on how these macroeconomic uncertainties play out. You can frame the investment case through those two competing scenarios we touched on, almost binary outcomes.
Okay, scenario one, the bull case.
The bull case, the generational opportunity. This depends completely on a soft landing for the U.S. economy. Inflation cools down towards the Fed's target without a nasty recession. The Fed gets the all-clear to start cutting rates.
And for the Russell 2000?
That's the perfect cocktail. Lower rates mean lower interest costs, boosting earnings. Easing financial conditions mean better access to capital. A resilient economy means decent revenue growth. So you get that potential dual catalyst rally. Earnings E rise and the multiple P expands as risk appetite returns,
And that historic discount to the S&P 500 narrows sharply.
leading to dramatic outperformance. From this angle, yeah, the current valuation looks like a highly asymmetric risk-reward. Maybe a great entry point if you believe in the soft landing.
Okay, but then there's the other side, the bear case.
The bear case, the value trap. This is the hard landing scenario. Inflation stays sticky. Fed has to keep rates higher for longer, maybe even hike more. Eventually, that tips the U.S. economy into recession. For those highly levered, cyclical Russell 2000 companies, it's bad news. Earnings don't just slow, they collapse, way worse than expected. Defaults, bankruptcies among smaller firms rise. Aggregate earnings could go negative again.
So the low-key E today was misleading.
Exposed as a classic value trap. It looked cheap, but the fundamentals cratered, making it even cheaper. The initial discount wasn't nearly enough for the actual risks. Could lead to long underperformance.
Given how different those outcomes are, what should we be watching? What are the key forward-looking signs for you to monitor to see which way things are leaning?
That's the crucial question for anyone trying to navigate this tactically, and these forward-looking signs are way more important right now than backward-looking valuations. Here's what you should keep a close eye on.
Okay, number one.
First, credit markets. This is the most immediate risk. Watch high-yield corporate bond spreads. Things like the CDX High Yield Index, or the spread between BA corporates and treasuries.
What are we looking for?
If those spreads are narrowing, it means credit conditions are easing, risk appetite is up. That's good for small caps, lowers their borrowing costs. If spreads are widening, major red flag, signals distress, tight credit, bad for the Russell.
Okay, credit spreads. What else?
Second, key economic data, especially the ISM manufacturing PMI. It's a crucial leading indicator for those industrial and manufacturing companies heavy in the index. A sustained move back above 50 means expansion. That's a powerful tailwind, signals stronger demand. Staying below 50, especially if falling, negative signal, continued contraction.
Got it. And
ISM, third.
third, the shape of the yield curve. Super important for all those regional banks. They need a steep curve, long rates, higher than short rates to make money easily.
So an inverted curve is bad for them. Really bad. Squeezes their margins. So watching for the curve to steepen, especially getting out of inversion, is historically very bullish for banks, and therefore the Russell 2000 signals a more normal lending environment returning.
Right. Credit, ISM, yield curve, anything else?
Finally, don't just look at PE ratios. Track the trend of earnings revisions. Are analysts upgrading or downgrading their earnings forecasts for Russell 2000 companies? Look at the ratio of positive to negative revisions or earnings revision breadth. If that starts improving, more upgrades than downgrades, that's a strong sign fundamentals are turning up, often leads a rally. Means the pessimism is lifting where it counts future profits.
Those are great, concrete things to watch. So pulling back to the big picture, what's the strategic takeaway here? Despite all these risks, where do small caps fit?
Strategically, despite the near-term worries, U.S. small cap stocks remain an essential part of a well-diversified long-term portfolio. They absolutely do. They offer unique exposure to a dynamic part of the U.S. economy. They're often where future giants start. And they've historically offered high growth potential over full cycles. Plus, they offer diversification, sometimes outperforming large caps, especially early in recoveries.
So strategically important long term,
Right.
but tactically tricky right now.
Exactly. The current environment demands a more tactical view. That historic valuation discount is compelling, potentially generational.
Yeah.
But it is absolutely conditional. It's entirely predicated on that specific macroeconomic outcome, soft landing, Fed easing. Buying the Russell 2000 today is a calculated bet that the market is too pessimistic, that the U.S. economy is more resilient than feared.
But not a buy and forget situation.
Definitely not. It requires active monitoring. Keep a close watch on those signposts we just discussed, credit, ISM, yield curve, earnings revisions, because the risks of a policy mistake or a sharp downturn are real, and they are fully reflected in that deep discount you see today.
It's a strategic allocation, yes, but one that needs tactical vigilance right now. A keen eye on that macro horizon.
Yep.
Wow. What an incredible deep dive. We've really unpacked the Russell 2000, seeing it's so much more than just small stocks. It's this complex barometer of Main Street USA, presenting a truly fascinating, if definitely conditional, picture for investors. So as you think about all this, here's a final thought to chew on. What does this persistent, sometimes historic discount we see in Main Street America really tell us about the true health and maybe the breadth of the wider market? And how much of this huge divergence between large and small, this market leadership concentration, how much is truly structural, maybe a new normal we need to get used to, versus just cyclical noise that'll eventually fade? We absolutely encourage you to keep exploring these ideas, keep an eye on those key indicators we discussed, and form your own informed conclusions about this really intriguing, often overlooked corner of the market. Thanks so much for joining us on the deep dive. And just a quick reminder for you, all analysis today is based on publicly available sources and, of course, may be subject to revisions or differing interpretations. This content is for educational purposes only and does not constitute investment advice. Always conduct your own due diligence before making any investment decisions. If you enjoyed this, please do like and subscribe us on Apple Podcasts, Spotify, or our YouTube channel, Deep Value Investing. And don't forget to check out the book list of value investing gems in the episode description. Also, if you'd like to support us and help bring a potential Buffett Indicator app to life, there's a link in the description. https://gofundme.com/turning-Buffett's wisdom into a daily tool for investors. Thanks again for listening.